You don't see them on your ballot. You don't meet them at town hall meetings. Yet they shape your paychecks, your mortgage, and even what you pay for groceries. They move capital, and that movement ripples across your daily life. Hedge funds aren't just financial entities. They are engines of influence. They don't produce goods or services, but their strategies touch everything you rely on. Welcome to Wealth Casebook, where finance, power, and modern life collide. And nothing is ever as simple as it seems. Most people have heard of hedge funds, but few truly understand them. The term hedge fund may sound like a specialized club for the wealthy, but it is much more than that. At its core, a hedge fund is a private pool of capital, gathered from billionaires, pension funds, and corporations, managed by a small team with one goal: maximize returns using any strategy the law permits. Unlike mutual funds, which are heavily regulated, hedge funds operate with extraordinary freedom. While banks report their holdings and limit risk, hedge funds borrow, leverage, and trade with astonishing speed. Mutual funds are like driving down a well-marked highway. Hedge funds, they drive off-road at top speed. They borrow to amplify bets, trade derivatives, and sometimes profit when markets crash. Derivatives may seem complex, but the idea is simple: a financial contract betting on the future value of an asset without owning it outright. You're not buying oil, stocks, or bonjour, predicting what they will cost tomorrow. Hedge funds thrive in this world of speed, secrecy, and speculation. The first hedge fund, founded in 1949 by Alfred Winslow Jones, was almost quaint compared to today's giants. Jones, a sociologist, used a strategy of buying stocks expected to rise while shorting those expected to fall. Shorting involves borrowing shares, selling them at the current price, and repurchasing them later if the price falls. Profit comes from the difference. If crises rise, losses can be unlimited. Jones hedged carefully to protect his portfolio, balancing risk with academic precision. By the 1980s, deregulation transformed the landscape. Reagan's government loosened rules. The Federal Reserve cut interest rates, and capital flooded Wall Street. Borrowing became easy, leverage exploded, and hedge funds were primed to profit. Free from banking licenses or public disclosure requirements, they existed in regulatory gray zones while becoming central to the financial system. If a regular investor plays chess, hedge funds play poker with borrowed chips at a table the public cannot see. By the 1990s, their influence surged. They traded currencies, commodities, bonds, and sovereign debt. George Soros' Quantum Fund, for instance, famously bet against the British pound in forcing the Bank of England to spend billions and earning over $1 billion in 1 week. Then came Long-Term Capital Management, LTCM, a fund run by Nobel Prize-winning economists. Its sophisticated models predicted crises were impossible until 1998, when Russian debt defaults triggered a cascade of failures threatening global markets. The Federal Reserve orchestrated a $3.6 billion private bailout. That moment revealed a crucial truth: for large enough funds, risk is negotiable. Hedge funds evolved from cautious market participants to market shapers. By the 2000s, they became trillion-dollar institutions, hiring ex-government officials, lobbying for favorable regulations, and leveraging complex financial instruments. Small teams could now control billions, amplifying modest investments into massive positions. Imagine $1 million. Conventional investing buys $1 million in stocks. With hedge fund leverage, that same million becomes $10 million in positions. If the market rises 10%, returns grow tenfold. If the market falls 10%, capital vanishes. High risk, high reward, powered by other people's money. And the consequences extend beyond the fund. Entire economies can feel the ripple effects. During the 2008 housing crisis, some hedge fund managers anticipated the collapse. They didn't simply warn others. They created products that profited when mortgages failed, making billions while millions lost their homes. Hedge funds emerged wealthier than ever, demonstrating that disasters could be monetized. Post-2008 regulations restricted banks, but hedge funds, largely private, filled the void. They became lenders, landlords, and market influencers simultaneously, purchasing entire neighborhoods, converting suburban homes into corporate rental portfolios. Today, in many cities, 1 in 5 homes is owned by institutional investors. Renters no longer interact with landlords. They deal with algorithms, spreadsheets, and shell companies. Ownership is obscured across states and tax havens. Hedge funds control not just assets, but legal, financial, and political infrastructure, extracting value at scale. They finance corporate takeovers, lend to distressed governments, and run a shadow banking network. By 2024, private credit markets exceeded $2 trillion, roughly the size of Italy's entire economy. Hedge funds do more than invest. They shape markets. Large positions move prices, influence policies, and attract central bank attention. They convert volatility into opportunity, scarcity into profit, and crises into wealth. Speed, data, and leverage allow them to bend markets to their advantage, influencing what Americans pay for housing, energy, and influence extends beyond finance. Hedge funds now maintain political connections, donating to both parties, attending private retreats with lawmakers, and hiring former Treasury officials as advisors. Some even maintain direct lines to central banks. This revolving door ensures rules favor those with influence, stabilizing power rather than constraining it. Their genius lies in profiting from both calm and crises. When markets are stable, they earn steady returns. When chaos hits, they position themselves to profit. They have effectively financialized disaster. Derivatives have evolved into trillions of dollars in layered contracts, covering interest rates, commodities, natural disasters, and even weather. Catastrophe bonds pay high returns unless disaster occurs. Hedge funds can literally profit from calamity. Risk becomes a revenue stream. Data is another frontier. Hedge funds track oil shipments via satellite, monitor factories with thermal sensors, and analyze consumer behavior through credit card records. Algorithms predict spending, voting, and mobility patterns. Traditional finance reacts to the past. Hedge funds anticipate the future. Analysts call them the intelligence agencies of capitalism. They don't control governments. They anticipate decisions before they happen. The most significant power is structural. When hedge funds own large portions of housing, debt, food, or energy, their presence shapes policy and markets. Attempt rent control and capital flows elsewhere. Overregulate derivatives, and liquidity evaporates. Penalize speculation, and pension funds, invested heavily in hedge funds, suffer. Public money, fed into private funds, fuels influence in a feedback loop, amplifying systemic power. Hedge funds rarely see themselves as villains. Many portray themselves as realists, liquidity providers, or market up. And, in some ways, they are correct. They accelerate capital allocation, spot inefficiencies, and expose weak businesses. Yet their success relies on a historical constant. Power concentrates until it merchant guilds in Renaissance Venice dominated trade routes until they eclipsed kings. The East India Company ruled nations while remaining private. History repeats itself. In the 21st century, the empire is built on leverage, data, and speed. Hedge funds are sovereigns, private, borderless, unaccountable. They don't raise flags, they raise margins. They don't declare war, they fund both sides. Nations need not be conquered, debts can be purchased. Policies shaped, economies influenced. The quiet control of America happens in spreadsheets, risk models, and algorithms that shape markets before breakfast. Empires once conquered land. Hedge funds conquer liquidity. As politicians argue ideology, hedge funds arbitrage it. Campaigns are funded, trade policies influenced, and every market-moving headline becomes an opportunity. Crises are trades, truth is variable, and the system keeps capital flowing. If hedge funds vanished tomorrow, markets would seize, credit would freeze, governments would panic. Their integration into the economy is deep, invisible, yet omnipresent. Ordinary citizens live in an ecosystem controlled by entities they cannot confront. Renting, borrowing, consuming all intersect with hedge fund structures. Algorithms, shell companies, and financial networks minimize individual power while maximizing systemic leverage. The economy is no longer just about supply and demand. It is about control, timing, and scale. Only those with speed, data, and capital consistently win. Ultimately, hedge funds have transformed modern capitalism. They convert volatility into opportunity, scarcity into profit, and crises into wealth. They shape markets, influence policy, and touch daily life without ever appearing in the public eye. Their strength lies not just in size, but in system design. Public money, private influence, legal sophistication, and technological advantage converge to create quiet, pervasive control. Hedge funds are the hidden architects of modern America, invisible, powerful, inevitable. And every system built on leverage eventually faces the same truth. You can't outmaneuver the market forever. If this gave you insight, hit subscribe. Wealth Casebook reveals the patterns. I'll show you where to look.